Hey, everyone. Before we get into today's interview, just wanted to drop a little reminder to stay up to date with all the latest episodes of On the Margin. You can subscribe to the Blockworks Macro YouTube. Just go up there, just click the little subscribe button, or you can click the links at the top of this episode. It'll take you over to Apple, Spotify, whatever your preferred platform is. Just subscribe there. If you could, leave a rating and review. Really appreciate it. All right, on with the show. All right, everyone. Welcome back to another episode of On the Margin. Today, I'm joined by James Lavish, who is a managing partner at the Bitcoin Opportunity Fund and the author of the Informationist newsletter. James, welcome to the program.
Thank you, Mike. It's a pleasure to be here and happy to talk to you.
Yeah, me as well. We've got a lot to cover here, so maybe let's just dive right in. I'd love to start. I think what I'd love to do is sort of tease out your view on the macro side of things, and then we can kind of work our way down the funnel into Bitcoin, your thoughts on where we are in the cycle and some of the work that you're doing at the Bitcoin Opportunity Fund. But, if I had to just ask you kind of from a 20,000 foot vantage point, when you're looking out at the macro landscape today, there's been quite a bit of focus on the treasury and supply dynamics going on in the bond market. People are zeroing back in on stocks, and people are asking this question about, is there going to be a recession, hard landing, soft landing, no landing? James, if you had to kind of look out there into this wide world of macro, how would you kind of parse out what are the driving factors right now?
Well, I mean, there's a lot of confusion about what's going on in the economy, and funny enough, there's the information we get from the Fed and the Bureau of Labor Services. It's a little bit obfuscated, right? So when you get CPI, they break out certain components that are kind of critical to the everyday person. Things like housing and energy and food costs. And they call it, a core inflation indicator. And so they give you numbers that may not match up with reality. And so that's one thing. You've got consumers have had a lot of cash on hand, and part of that is because of the stimulus checks and the programs that the Fed ran during the pandemic. Just handing out money to a lot of small companies and people. And so, but that's running out. And so now you see the consumer credit is at all-time highs. And now you're starting to see, actually, Mike, you're starting to see that delinquencies are up and that the younger generation's under pressure. But I was reading this morning on Bloomberg that the interest payments are now, they've surged. I mean, it's almost like it's like a cliff face from just the last few months or beginning of this year, that personal interest payments as a percentage of income are now up around where they were just before the great financial crisis recession. So, and you can see it spike every single time before a recession, and now it's spiked right now. And though we haven't seen quote unquote a recession yet, full on recession, I fully believe it's coming. And there, if you look back in time, and you look back at things like the yield curve and inversions and job losses, one of the things that the Fed likes to point to is, well, job losses are, the job market is still strong. And jobless rate is still at historic lows or near historic lows. But the reality is they're rising. And the other reality is jobless rates don't spike until after a recession starts. So you'll see it start to tick up. And then every single time that we have a recession, that's when the jobless rate spikes. So it's not a great indicator. It's a great way to look back and see what happened, but it's not a great leading indicator. It's lagging, severely lagging. And so that's one of the problems that we have is now you look at the market, and we've got 7 stocks, the Magnificent Seven, that have been driving the stock market, the S&P 500, for months now, and ever since the AI hype. And there is some reality around this. NVIDIA is selling a lot of chips because of the need for a certain type of processor for these processes of AI. And you've got these companies that have been soaring. and they've been carrying the S&P. If you look at if you break out those 7 stocks from the S&P, they're the ones that have the highly skewed PE ratios. So there are forces that are acting against each other. The Fed printed a massive amount of money during the downturn and the pandemic. And I think that with them raising rates at a skyrocketing pace, and with both consumers and small businesses now starting to feel the crunch, we're starting to see loan delinquencies, not just on the consumer side, but also on the corporate side. And you're starting to feel that crunch, which is the skyrocketing of those rates, and the tightening of the money supply is starting to impact companies and small businesses and individuals. And so I believe from a very high level, we're heading into a recession. And just the question is how hard are we going to land? How deep is it going to go? How long is it going to last?
All right, everyone, we will be back to the program in just a moment. But before we do, I wanted to give you the inside scoop about something that we've been cooking up at Blockworks these last couple of months. So in March of this coming year, in London, Blockworks is going to be gathering 1,200 of the world's largest asset managers. So that's fund managers and allocators, financial institutions, think big banks, payment providers, etc., and professional traders at the largest institutionally focused conference in digital assets, DAS London. Now, it's very rare that you get the likes of JP Morgan, Goldman Sachs, Point72, the large HFTs, the family offices all in one room at the same time. So if you want to know what the big money is doing in digital assets these days, this is the conference for you. To give you an early sneak peek at some of the stuff that we're going to be talking about, one, the intersection of macro and digital assets, and where are we in the market cycle. We're going to be talking about real world assets, so that's stable coins, on-chain treasuries, all of that fun stuff. And we're going to be talking about things from the allocator perspective. So what are the big money managers in crypto doing these days? And because you are such a good listener of On the Margin, I'm giving you an extra code, MARGIN20. So click the link at the bottom of this episode. Again, use code MARGIN20, and I will see you in sunny London town in March. Okay, so I wanted to, there's a bunch to dig into there. So one of the questions that I've had for you about this recession is, if we rewind the clock back to beginning of this year, the economists that were surveyed by Bloomberg, it was like 99% of them were very confident there was going to be a recession this year. So what did we get so wrong about that, right? How can we be confident now that there's a recession in Q1 or Q2 of this coming year? Or what did we miss this year when we were so certain about it? And then I want to return to the point that you made about the Magnificent Seven and AI.
We just underestimated how much extra cash there was in the system. The housing market it's perplexing, to say the least, because housing prices have stayed very high. And because of that, those are assets. That's the largest asset on most individuals' balance sheet, right? They're the equity in their house. And so housing prices have stayed high. Why? Because they're not moving. Houses are not selling. Why? Because who wants to sell their house, even if it has greatly appreciated in price? Who wants to sell their house and give up their 2.5%, 3.5% interest rate on that house in order to go buy another house, which would likely be smaller for the same price at an interest rate that is 8%? So it doesn't make any sense. So people have been holding on to their houses. The inventory is not moving. And so that's one of the things that a lot of people kind of, I wouldn't say they missed, but they kind of overlooked. And so that's one thing. And so asset prices they're still high in that area. And just the sheer amount of capital that's in the system was also overstated. Another thing is, look, we've been running massive deficits. The country is running deficits, and that's inflationary, and it stimulates the economy because you're basically borrowing from the future, right? So when you look at debt, and this is one thing that we talk about a lot on different podcasts, debt in and of itself is not a bad thing, Mike. So it's just, all it's doing is it's pulling future productivity into the present. If you can use it responsibly, if you can use that debt responsibly and borrow an amount that makes sense for you as an individual or your company, then that's no harm, no foul. However, the government isn't doing that. And so we're running these massive deficits. We got into a position earlier this year at the end of May and beginning of June where we were about to trip the debt ceiling. So instead of figuring out how to lower expenses, we just kicked the can down the road on the debt ceiling, put a moratorium on it. Now we don't really have one. And so in between the time that we kicked that can down the road and today, we've added over $2 trillion of debt in just a few months. And so the government spending has been massive. Now that's going to come home to roost because at some point we do hit a recession. The economy does grind. It does grind slower. That ease of capital is tightening quickly. And so you're going to see interest rates will come down in the short term, in my opinion. On the long end of the curve, they'll come down, and all interest rates will come down. You'll see the entire curve come down. But as longer term, what you'll see, and an indication of that was the bond market, the bond auction we had a few weeks ago, the 30-year auction, which was absolutely abysmal. That was kind of a preview to the problem that the Treasury is facing, which is we are borrowing so much that the likelihood that we're going to have a tsunami of debt in the near future is rising every single day. Every single day that we run the deficits that we're running, which is now at an annual run rate of over $2 trillion, that gets worse and worse. And the likelihood of that gets higher and higher. So there's a lot of forces here, Mike, that are working against each other. And it's an extraordinarily difficult market to be an investor in at this moment.
Yeah, I tend to agree with you because I think I'm in the camp that I agree with you on the debt issue. But one of the challenges with that has been that the U.S., if you want to define what's been going on with our current fiscal situation and taking on deficits that we can't sustain is kicking the can, I think what has surprised everyone is just how long we've been able to kick this can. Been referenced many times on this program, but you can go back. I've got it on my bookshelf here, Market Wizards, which was written in, I believe, 88 or 89. And you could superimpose a lot of the conversations, the exact conversation that you and I are having today, what people were talking about back then. We were just starting to run deficits in the billions of dollars, and people were saying 40 years ago that this was going to be the end. And we were going to go into this wage debt spiral that we're talking about today. And it didn't happen. And one of the challenges, I think, is people sort of talk past each other in terms of time frame on the debt issue. But that is the devil is in the details there, because it's just so difficult to nail down when this becomes a problem. Because I think if you had told even the numbers that we talk about today in a very casual sort of way, $1 trillion here, a trillion, running a $2 trillion per year deficit, you told that to someone even 10 years ago, you'd say the US must be in a state of crisis. There'd have to be a war going on or something. But clearly that's not the case. So it's just really difficult to pin down that timing.
Yeah, well, okay. So, and that's true. And people pointed to Japan and say, look, we could be just like Japan, run 350% or 250+% debt to GDP. Our central bank can buy most of our debt. And look, Japan owns most of their own debt. The Bank of Japan owns more Japanese debt than anybody else in the world. And it's just astounding, but they own over 50% of it. So, but we're a different economy. And we have we're net importers and they're net exporters. We have a different aging demographic than they do. And we have a different financial system than they do. And so, but the issue here is, and one of the things that gets overlooked is that, it's just something that we sometimes take for granted, is that the U.S. Treasury and the US dollar are the global reserve asset, and the global reserve currency, which gives us a very long runway on this debt issue. Now, that doesn't mean that it solves it, but it does give the Fed and the Treasury a whole lot of rope to keep playing this game. So the Treasury knows it. The Treasury already put out a report earlier this year in February. And the report it's a report on the Treasury. It's basically the state of the Treasury and how are we doing. Now let's back up a bit. First of all, the Treasury isn't deciding the spending. The Treasury is just enabling the government to spend. They're facilitating it. They have to figure out a way to facilitate all the spending and operate in that budget. And the way they've been doing it is issuing debt. And so they put out this report back in February that basically said it was the state of the Treasury, and then the subtitle was an unsustainable fiscal path. And they showed this, and I believe they've taken it down recently, but they showed this chart which just demonstrated how quickly debt to GDP was rising. And they were basically telling the government, it was a red flag for the government to say, we can't keep doing this. At some point, this breaks. At some point, we do enter some sort of hyperinflation because of a loss of confidence in our currency. Now, again, what's happening and how we're doing this, and as these rates do end up rising, and we get what you call rate premium, is you're going to see other currencies struggle and collapse. They'll collapse right into the US dollar. Argentina almost did it. And so this is natural and unfortunate, and it causes a lot of pain around the world. But because the dollar is so strong and everybody uses and trusts and needs them because of dollar denominated debt, because dollar denominated transactions, this has put us in the position of being able to do this for a very long time. And you look back, Mike, and when did this start? It started in 1971 when Nixon officially took us off the gold standard, and we came up with an agreement with Saudi Arabia that they would transact in US dollars for their oil. And so that's been going on ever since. And that's given us a lot of rope because it makes other countries who are energy dependent have to hold US treasuries in order to have access to dollars at all times to buy that energy. So they sell the treasuries, they get the dollars, they buy. And so, but the world is waking up, and you're hearing frustration from countries like Brazil and Saudi Arabia and India, the BRICS, Russia, and they don't want to be beholden to the US dollar anymore. Why? Because they know that we're running these huge deficits and we have no choice but to have long-term, perpetual, structural inflation, and inflation that we don't admit to. And that's the biggest problem. And we're starting to feel it across the economy, and individuals are starting to feel it. You see, there every single day, there are thousands and thousands of videos of people on social media saying, I don't understand how people are making it. Everything costs so much. Who has a job that pays them enough to spend money like this, and to buy food that costs as much, to buy houses or cars that cost as much? And so it's becoming a problem internally. And that's kind of a big red flag for us. So you're a lot younger than me. You don't remember this, but back in the 1980s, we had a similar problem of inflation, and it was painful. It was severely painful. Now, back then, though, because we were running 30% debt to GDP, Volcker was able to raise interest rates up to 20%. Can you imagine if we did that now? Our debt and our
it's even an option, right?
It's not an option, because our interest payments would balloon to become the largest. They would require all of tax payments if we did that. And that's just, so we're already at the point where tax payments on our debt are at an annual income, the interest payments on our debt is already at a run rate of $1 trillion annually. Just the interest payment on the debt. Now, if you figure we're taking just over $4 trillion of income or of revenue from tax revenues, that's like 25% of our revenue. That's just insane. And that's where we're at right now. And so to go back to your first statement of, it always seems like, we've been talking about ad nauseum, and we have, and I'm not saying this time is different. I'm just saying that this cycle is showing how each cycle it's getting worse and worse and worse. And so now we're running debt to GDP of 130%. We're running deficits of about $2 trillion. Our interest payments on our debt is $1 trillion. Our debt to GDP is 130%. I mean, these are problems that are not going away, and they're only growing exponentially unless we do something and change it.
So what do you think the forcing function ultimately is? Is there some percentage of the, of tax receipts or something like that, where it's like, whoa, right now it's 25%. The run rate of what we have to pay in terms of interest is, 25% of what the US government spends in the course of a year. If we get to 30 or 40 or 50%, are we going to wake up and say, hey, this is just ultimately way too much? Or is it if there's some sort of reacceleration in inflation and, I don't know. I mean, I hate to do this.
It's a good question. It's a good question. And the way I look at it is, look, we're in a debt spiral. That's the premise. We are in it. We can't get out of it. So when you're running deficit like this and you're having to, so you're running such large deficits. What are your choices as a government? Your choices are either austerity, which is cutting expenses. Well, that's political suicide. Each party is trying to trick the other one into doing something like that because it loses the confidence of their constituents, right? So they lose votes. So neither party is really going to do it. You hear both parties chirp about it every single election cycle, spending, but nobody fixes it. The debt ceiling is raised every couple of years. It doesn't matter the party. Spending keeps going on. So that's not going to happen. The second thing you do is you could raise taxes. Now, we hear about this all the time. Like, here we go into another election cycle. Let's just raise taxes, tax the rich, tax companies, tax these corporations that are making so much money. But the reality is, when you do that, you wind up disincentivizing investment into those companies. You disincentivize, research and development, and you disable the ability for companies to expand on their product lines, to expand into new products, to hire more people, to pay more money, and you wind up decreasing their margins. So at the end of the cycle, even when you raise taxes and you're getting a larger share of the revenue in, the revenue's smaller. So you end up getting to the same place. It doesn't work. So that's the second thing. That doesn't work. The third thing you can do is just issue more debt. That covers the deficits every single year. You pay down, you have to, when debt matures in this country, we don't have the money to pay back what we borrowed. So we have to issue more debt in order to have the money to pay the principal back on that debt. And we hope that whoever we're paying that back, that investor, turns around and reinvests it in the new debt. That's what we're hoping. And it's been working more or less, but the engine is grinding and grinding and grinding. So we're getting to the point now, Mike, where that gap is just growing and growing and growing, right? So the issue, and that's why you're seeing the debt grow and grow and grow. $2.4 trillion of debt we've issued in 5 months. It's just insanity. Okay. So what's the other option? So you can default on your debt. You can default. You can declare that you're only going to pay 50% of what you owe on the debt. And we've seen this happen in different countries and different areas of the world that have gotten into this debt spiral problem. Think, places like Greece and what, but why would you, if you're a country that issues debt in a currency, in the same currency that you can print. Why would you do that? You wouldn't. You would just print more money and monetize your debt, which is what we did back in the pandemic. We monetized over $5 trillion of debt. So you're not going to default. But you hit on it, Mike, just a minute ago. The last option, and the option that we are obviously going to implement, is a soft default. What's a soft default? A soft default is having high, perpetual structural inflation forever. And that enables you to grow your GDP nominally, right? So your GDP nominally grows, and those are on those fake dollars, because now you have more dollars in the system. You printed money, you put it in the system, now you have more money. And so you've got inflation of prices, but there's more money. So those dollars that you borrowed 10 years ago on that debt, now you're going to go pay that back, but you're using dollars that are cheaper. They're worth less because there's more of them out there, So, that's the solution that we're implementing.
What's going on, everybody? Thank you for listening to On the Margin. I just wanted to take a quick moment to let you know about a very special offer that we have coming out of Blockworks Research. Now, many of you will probably be familiar with our platform, but Blockworks Research is the most blue chip spot to get research, data, governance, models, and a whole lot more about the leading DeFi protocols in the space. I've leaned on our analysts time and time again to explain complicated concepts going on in DeFi to me like I'm 5 years old. They can do the same for you. If you invest in DeFi or are just interested in it, it is an absolute no-brainer. As a listener of On the Margin, and to say thank you all for listening to the show, you can use Margin 10 for a 10% discount, and that gives you access to everything, which would be weekly in-depth reports, live data, all of that good stuff. So again, that's code Margin 10 for a 10% discount. Link is in the show notes. Sign up now. Thank you later. So, okay, I completely agree with that. That's also where I think we're going as well. I just don't see what other options we even have. No one talks about paying debt back. These levels are, all of the discussion around this is, can we even just maintain the current levels of servicing the debt that we have? And even that's like an open question, right? But no one's out here pretending we can pay any of this back. So eventually we're going to need to find a more sustainable solution. And I agree, the soft default, also known as financial repression, where inflation is a big component of it. Here's the way that I think about this. When I hear inflation, I just think a reshuffling of wealth, right? That's what that is. It's just, you can't create or destroy wealth by creating or destroying dollars, right? All you're doing is changing the relative allocation of wealth within a certain within the population.
If you include assets and illiquid assets as part of wealth, like houses, like fine art, absolutely.
Right. So here's the question. Who wins or loses in that? And this is where I feel like I get so many different answers when I ask this question, because immediately what everyone says is the poor, inflation is a very regressive tax because it taxes the poor or the lower income people disproportionately. But actually, if you look at wage data from the last couple of years of inflation, the group that did the best actually was the lowest income earners in real terms. So, and that actually doesn't really square. The person who I think has given me the best explanation of this over the years is Lynn Alden, who benefits is the opposite of basically people that do not own debt, right? If you are a creditor, you are the one who is getting debased here, right? Because you are owed a nominal amount in fixed income for whatever that debt is. So if inflation keeps churning, right, you're going to wake up and that nominal amount that you were supposed to get is going to be worth much less. Conversely, the people that benefit are actually the borrowers, right? So if you have a mortgage that's worth, say $1 million, and that's quite a bit today, you run inflation 10% a year in 10 years, that's not going to be nearly quite so much in terms of nominal amount, because the amount that you owe is still $1 million, but theoretically your income would have grown quite a bit. So it always puts my brain in a little bit of a pretzel, and I sort of have a problem with this popular narrative.
Yeah, and I love Lynn's explanation. She is absolutely brilliant. She got me one of her books at the last conference I was at with her, and she's awesome. And that's a great explanation. I want to take it one step further. The people who lose are also the ones who their wages, their real wages are not really keeping up. And so who is that? And it's the ones who don't have any assets and they don't have any debt. So they're not benefiting from those paying back cheaper dollars, but also they're being hurt by this hidden inflation that you cannot tell me that the price of goods and services over the last couple of years are only up 12% or something, not even. So the CPI numbers they're absolutely being manipulated for a good purpose. If you're at the Fed and the Treasury, so the issue is, are those metrics true? Are the low wage earners really keeping up? Are those real wages really keeping up with inflation? Because if you look at if you ask anybody at the lower end of that echelon, then you're likely to get the answer that is no. And the other thing is, how many jobs do they have to work to keep up with that inflation? Right. So I think Lynn's answer is brilliant. It's in the perfect world of how we're reporting things. And she would agree with this, that, that would be true, but we're not reporting things properly. And so that's part of the issue. But if you look at it now, go back to what you were saying about the confidence in the dollar.
Mm.
So the issue is that, the Fed they're supposed to have stable. They're supposed to make sure they oversee stable pricing, right? So they want to make sure that we have stable pricing in the system. What does that mean? That we don't have inflation that runs out of control or deflation that runs out of control. You want stable pricing, and they want full employment. That's supposedly their two mandates. In reality, why do they go to first principles? Why do we need stable prices? Because we need confidence in the dollar. Okay, now who are they answering to? Well, they're answering to the Treasury, because the Treasury needs a stable dollar. Why? Because they need confidence in the dollar. Why? Because they need to keep borrowing. They need to keep issuing debt. They need to be sure that they have that avenue to facilitate all the spending that's going on in Washington. So that's the way it's flowing down. And so that's why CPI, PCE numbers, like these numbers, they're super attentive to the volatility of these numbers and the sensitivity of them, because they want to be sure that there's confidence. We need to maintain confidence in the US dollar. And that goes back to your initial first statement of, when does this happen? What happens when people lose confidence in the dollar, where real inflation, true inflation, is so high that people don't want to hold dollars anymore. That's when it happens. And when that is, I don't know. It's not going to be next year. It's not going to be in 5 years, but could it be in a decade? Could it be in a couple decades? It could, because of the exponential rise in borrowing and debt.
One more question about just the wages, because this again also puts my brain in a little bit of a pretzel, just to put my hand up, but that doesn't really pass. When people say I understand that there's a real component to people's wages, but it doesn't actually pass my sniff test of the wages don't keep up with inflation. I feel like, if anything, actually, the lower income to even middle income people sort of come out on top of this, because I feel like what ends up happening and the delta, because one person, again, when price is going up, someone's income is going up, right? Like one person's cost is another person's income. That's just how money circulates through the economy. And I think the delta in between people's wages and inflation is profit margins for businesses, right? Like if a business can sort of protect its profit margins and continue to charge more while not paying its workers quite as much, that's how you get a delta in between prices and costs and the wages of individual people. But I think what just having read quite a bit about the inflation of the 70s and 80s and what you're already starting to see now with the, this renewed strength of unions and the union auto worker strike and things like that, is that's what comes after, right? Inflation kicks up. Everyone feels the pain. Everyone sees record corporate profits and earnings. This popular swell ends up happening. And then there's an enormous amount of pressure that gets put on profit margins for companies, which we haven't actually seen yet. Corporates in the US have been really good at defending those profit margins, but I feel like that's the next thing that ultimately ends up getting squeezed. And I do think there are even like two types of companies, right? And there is like very high duration companies, which they don't make a whole lot of profit. And then there are companies that make a lot of profit now. So again, I just think that there's a lot of nuance here in terms of how this reshuffling ends up happening. Probably hard assets end up doing quite well. Bitcoin, real estate, things like that. Different corners of the stock market will do a better job of preserving wealth than other corners of the stock market. So there'll be a reshuffling there, and then bondholders just get crushed. Is sort of how I see it as in general.
And in general, at the end, I think that's a solid viewpoint. However, let's move back a couple of steps. Number one, the delta for someone who has so quality of life, right? So if you can pay for your food and energy and your housing, okay, then you can survive and you can have a somewhat comfortable quality of life. However, when prices rise so much and you're at the low end of that earnings curve and all asset prices rise, well, that the multiplier effect on those larger things, so anything that's not a necessity ends up being out of your reach. So your quality of life is likely to diminish. So because you're not going to be able to keep up on that any of the larger purchases. You need a new washing machine, you want that new TV. Not that that's necessary, but maybe that would raise your quality of life, or maybe you want a better bed. That would raise your quality of life. But have you seen the prices of beds? So like the things like it. I just don't think they're keeping up in that sense. Number one. Number two, when you have these cycles, and this is the problem. This is what maddens me. Is that when you have the manipulation of money and you're going in these cycles, you continuously go in these, ebbs and flows of the economy. And then you get into one of these downturns. Well, who gets hurt? Who gets hurt the most in that downturn? Who loses their job, right? You're going to have a little bit of a barbell, but typically, you're having a swath of wage earners that are not critical to a company that get laid off. And so all those layoffs and that recession winds up just doling out economic pain across the board. And so at the end, we've been conditioned now to the Fed and the Treasury coming in and dumping liquidity into the markets. Why? Because they need markets to operate, to function properly. Why? Because they need the treasury market to operate properly. Why? Because they must be able to issue more debt. So we've been conditioned that they're going to make sure that large companies don't fail, that large banks don't fail, that the market doesn't melt down, that the treasury market stays liquid, and if they have to dump liquidity in there to ensure that, then they will. And who makes off from that? Well, just like you just said, it's the Cantillon effect, right? Or the Cantillon effect, if you're French, where the one who's closest to the spigot, the ones who are closest to that liquidity spigot are the ones who benefit the most. And so asset owners, people who own large houses, who own gold, who own Bitcoin, they're going to benefit in this cycle, in my opinion.
I think I agree with most of that. The one data point though that I sort of think about is if this were true, right? And I get into this debate a lot with Mark Yusko, who's my co-host on the roundups of this show. But if that were true, and this whole system ran based on this sort of, the Cantillon effect and then you would expect wealthy people to actually want this inflation. And I actually don't get that sense. I think actually the other dynamic that's underlying this, and something that I've sort of had as a base framework through which I view a lot of this, is this sort of shift or like this push-pull in between labor and capital. And I think actually for the last 40 or so years, since the post-Reagan Thatcher era, just capital has been thrashing labor. I mean, just put it in a body bag. The unions have been defanged. All the asset owners have done extremely well. And I actually see, I guess what I'm trying to get at here is I sort of see a reversal of that in this run-up of inflation. I think the bargaining hand moves back to labor a little bit, and there's kind of a reshuffling in favor of that. But I think where you and I are in 100% agreement here is what Bitcoin does. And just because I'm assuming many folks listening to the show will be very familiar with sort of the argument where the Fed has to come in, backstop more and more of the market. You can't print something like Bitcoin, so Bitcoin's value goes up. I think to maybe update, I guess, you and listeners, because I haven't talked about Bitcoin an enormous amount or my sort of changing views on it. I want to, like, Lynn has this great, I know we're just referencing, this is a Lynn appreciation episode here now, but there's this kind of like, I'm so bearish, I'm bullish. Where basically, like, I think the system is so broken that actually assets have to do well in kind of the mid to long term because the Fed's going to have to come in and backstop everything. I started to feel recently, and I would love to get your thoughts on this, I might be in I think I'm in that camp for now, but I think eventually that transitions to I'm actually so bullish, I'm bearish. And what I mean about that is, like, I've been so positive about Bitcoin for so long. It's still the thing that I own the most of. Like, I'm just a massive supporter of it. I've just seen and bought into the vision now for such a long time that I'm actually starting to worry. In recent years, there's been so much money printing and the system is so obviously broken, and that's going to come to a head. And that's going to be at the very center of what policymakers are going to have to do. Now, that's so bullish for Bitcoin. I guess where I'm starting to maybe get a little concerned is if this all comes to a head and, Bitcoin obviously does very well price-wise, I start to get more worried about people banning it. It's hard for me it's easier for me to see a world, right, where when everything's breaking and there's runaway inflation and the financial repression has moved into the mainstream and Bitcoin just does very well, where policymakers are like, hey, we don't want people to have this ability to opt out. So what do you think about that idea?
There's a lot to unpack there. Well, first of all, I do believe I'm with you. I believe I'm so bearish on the system that I'm bullish on Bitcoin. I'm hugely bullish on Bitcoin. I came to the party much later than most of you, and I also come from that institutional investing world, like Mark does. However, and that's part of the issue is that the people who have benefited the most from this system are not apt to look at Bitcoin as something that helps them because they don't need something else. Warren Buffett doesn't need or want anything else. Neither does Charlie Munger. Neither does Jamie Dimon. Like, they do not want this. Why? Because it is tremendously disruptive. Now, why doesn't somebody like Elizabeth Warren want it? Because she cannot control you with it. It is out of her purview of control, and that's a problem for her. So that goes back to your point of, okay, as this gains traction, and as we see in the next 3 to 6 months, we have multiple Bitcoin spot ETFs approved, which enables many institutional investors, small offices, small family offices, and those who just have not been able to convince their investment committee that holding Bitcoin is something that is not a reputational or a career risk. They have not been able to get to it because of the internal controls on buying, on settling, on custodying, on pricing, on market, on Bitcoin. They just have not been able to get there. And so when we do have those ETFs, it's not only going to enable certain family offices and institutions to be able to buy Bitcoin immediately. It's just like buying a stock. They can settle it with their prime broker. It's no big deal. They have a custodian already. But that's one step. The second step is it's going to force a an entire an entire sector of investors that have been ignoring it. It's going to force them to look into it and understand it. And so having that understanding is really the next big step, which makes me tremendously bullish, because there's no arguing that the fundamentals of Bitcoin, it trumps even that digital gold narrative, which will be the first narrative. That's going to be the first narrative. I agree with Michael Saylor on this, that the first use case for most investors is going to be digital gold. Then we move into the we need to control this phase, right? So what are the options? Can they ban it? It can't be banned. I mean, you've seen what happened in China. They I don't know if they pretended to ban it. It's difficult to understand what their policies are with that regime, but China is still one of the biggest Bitcoin miners on the planet, if not the biggest, right? So,
I actually, not to interrupt you there, but I was going down the rabbit hole and listening to some old Epicenter podcasts from 2014 timeframe, and there was a really great there was an episode that I was listening to where it was 2014 and some guy from CoinDesk, and he introduces himself. You might have heard of us. We're this up and coming little brand. It's CoinDesk in 2014, and he was going through what some of the big trends were at the time. And this was, just post Mt. Gox blowing up, and what he said was the industry is too focused on price. How many times have you heard that, right? This is the big criticism that everyone outside loves. Oh, you're so focused on price. Okay. So they were saying this all the way back in 2014. China just reversed a ban on Bitcoin. And the US government sold some Bitcoin, which was like federal acceptance of Bitcoin. And they're rolling out some stuff. And I was like, you could literally superimpose these conversations in 2014 over the current day, 9 years later.
It's incredible.
And it would not even be out of place. People wouldn't even question it.
It's just incredible.
So funny to me.
It's incredible. And then there you go. And so, I think we get into the spot here where people are a little bit worried about, but once we get the ETFs and it's widely owned, they can't ban it. I just can't see them working against BlackRock and Fidelity and, State Street and Texas Teachers and CalPERS. And like, that would be such a monumental move. I can't get there. They could tax it significantly in a way or something, but these ETFs, once they get approved, that's like a stamp of approval that I believe will put this into the mainstream, and that's it. The cat's out of the bag. And then the number go up technology is interesting, of course, because you're seeing this influx of capital into the space that's tremendous, and that's going to be the digital gold narrative. But as that comes in, you're going to see this expansion on top of that, on the next layers, on transaction layers, on the second and third layer of Bitcoin that enables just a whole new array of technology and companies that are going to capitalize on that. And that's something that's super interesting. This goes beyond the miners. This goes into software solutions and hardware solutions, and and Bitcoin enabling, the Bitcoin layer enabling things that we just can't do right now in a way that is more secure and doesn't need the trust, because it's trustless, that the other cryptocurrencies need, because they're central. They're centralized. Where the decentralized nature of Bitcoin enables a growth in an industry that we would not have seen. We had the internet, we're going to have AI, and we're going to have the Bitcoin industry. And those are the two big developments, I think, that are coming down the pipe. And it's going to be interesting. It's going to be exciting. And that is exactly like you and I were talking about before the show. That's exactly why we started the Bitcoin Opportunity Fund, because we see tremendous opportunity. We're talking to people and we're investing in companies that we're super, super excited about. And so, it's an exciting industry. I think it's just going to develop exponentially from here.
Yeah. I do got to poke at you because I do think some of the other cryptos are decentralized. I would put Ethereum and Solana actually not in the same camp of or same amount of decentralization as something like Bitcoin. But I think there are projects out there that are, Bitcoin is the oldest and it has had the longest time to decentralize. But so I got to poke at you there, defend some of my other interests here. But tell me about what's going on in the Bitcoin Opportunity Fund. Like what are some of the projects that you're sort of seeing in and interested in and investing and supporting? And then I want to hear a little bit about the informationist as well. And maybe we can sort of close on that as what some of the stuff that you're writing about.
Awesome. Yeah, the Bitcoin Opportunity Fund. It is a hedge fund private equity. It's a hybrid. It is for accredited investors. It's not my rule. It's the SEC's rule, unfortunately. But for those who are accredited, what we do is we invest in both public and private companies, and all in the Bitcoin space. And so we're finding opportunities all over the place, whether it's public or private, whether it's early stage or late stage, large companies, small companies. We've bought straight equity. We've bought some preferred equity. We've bought debt with preferred. We've bought just private, straight private shares. So we can operate anywhere in the capital structure and across the world, but it's in the Bitcoin space. And so any opportunity that we're seeing. And so what's unique about what we're doing is we're not like a venture capital fund who has to find those early stage companies. And we're not like a public hedge fund and focused on basically just the miners. We're finding opportunity all over the place. And so we're super excited. We've got some great investments that if people are interested, they can go to bitcoinopportunity.fund. And we've got a webinar that we talked about all the investments we made and some of the stuff we're super excited about. I can't say too much about it because, SEC rules, but it's a super exciting space to us.
Awesome. Well, guys, I highly recommend you check that out. And then, James, on our closing minutes here, you've been super generous with your time, but talk to folks a little bit about the newsletter that you write, the Informationist.
Oh, yeah. So I write a newsletter every single week. It's called The Informationist. And what it does is I take one complicated concept, a financial topic that's probably top of mind. People are thinking about things like the debt spiral or the treasury auction, the reverse repo, like stuff like that. And I just boil it down super simply into like a 5 or 7 minute read, and anybody can understand it. We've got doctors, lawyers, engineers, dancers, firefighters, and there's almost 25,000 subscribers now in just over a year. So it's been great. I love it. It's a great community and it's free. So you can just go to jameslavish.com and sign up for the free newsletter there.
Well, I appreciate the time, guys. I highly recommend that you check out The Informationist and the work that James is doing at the Bitcoin Opportunity Fund. James, this was a ton of fun. We'll have to do it again soon.
Absolutely, Mike. Thank you for having me.
Cheers. All right, everyone. Thank you for tuning into that great interview with Michael. Just as a reminder, I know I've mentioned it a couple times throughout this interview, but Michael is going to be with us in person at our Institutional Digital Assets Conference, DAS London. That is March 18th through the 20th in London. Michael is going to be joining us talking about liquidity, inflation, monetary hedges like gold and Bitcoin. There are going to be many of the on the margin interviewees from the past and a lot of the big institutions, the BlackRocks, the Goldmans, et cetera. So if you're into digital assets and if you're into the type of content that we just covered today, I highly recommend that you go. There is a code MARGIN20, which is going to get you a 20% discount on tickets because you're such a loyal listener. And I appreciate you and just genuinely want to see you in person in London. So thanks very much. Hopefully see you in London, March 18th through the 20th. And again, use code MARGIN20.